You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi everyone, it's Jake here. Welcome to The Voluntary Life. This week's episode is about investing, and I'm going to be talking about bonds. I'm going to tell you about some weird things to do with investing in bonds, some strange properties that they have that I found it very useful to understand, particularly if you're interested in investing for your own financial independence in the future. And if you plan to invest in different asset types, bonds may be one of those investment classes that you're considering. And I think there's some useful things to understand about bonds. So that's what this week's episode is going to be about. Before we get to that, though, I just want to say a big thank you to my new patrons on Patreon. Thank you very much to Link W and Christian V. If you're interested in supporting The Voluntary Life and you would like to get hold of bonus episodes and many other rewards, check out more about that on my Patreon page at patreon.com/thevoluntarylife. And you can also find more info about that on my website, thevoluntarylife.com, and I'll put a link in the show notes too. So on to talking about bonds and investing. Now, what I'm going to tell you is my understanding of some interesting characteristics of bonds. As I've said many times before, I'm not a financial advisor. This is just my own perspective. So do your own research. And of course, your money is your responsibility. But hopefully, by sharing some of the things that it took me a while to understand myself about bonds, it will help you if you're interested in understanding what some of the strange properties of bonds are as an asset class. What you probably already know about bonds is that they are a cash flow producing asset. Essentially, it's a bit like making a loan. You buy some bonds, and in return, you get interest payments on those bonds. And the bonds may last for a particular amount of time. They could be short, like 1 or 2 years, or they can be very long, like 30, 40, 50 years. And at the end of that period, you get the nominal value of the bond back. Now, you may not have bought it at the same price as its nominal value. So if a bond costs $100, you might have bought it at $120 or $80, depending on how the market valued the bond. So that's something that I'll explain more about. But the point is, if it's worth 100, then you get 100 back at the end of the bond's term when it matures. So you're essentially kind of buying a loan. And normally that loan is to the government. They're usually issued by governments, but you can also get corporate bonds. And they pay back interest on these loans over a period of time, and then they pay you back the principal. So that all sounds fairly straightforward. And when you get into investing, you will often find that people recommend bonds as a way of diversifying instead of having a portfolio of investments entirely in stocks. And the idea is that bonds provide a bit more stability because they're less volatile than stocks. So the often heard advice about bonds is that when you're young and investing early in your sort of investment career, if you like, you should invest a lot in stocks and only a little bit in bonds because you don't want that much stability. You want to try and grow the portfolio. But then as you get older and you're closer to retirement, then you increase the percentage of your portfolio that's in bonds because it's a little bit less volatile and you don't want to be losing money later. You're not trying to make extra gains and so forth. So that's something that you may have heard about bonds. Bonds are an interesting asset because they do well in times of prosperity, when money tends to get cheaper, but they also do well in times of depression, like since 2008, when interest rates are pushed low, but there isn't an economic boom going on. And usually that's because of the actions of central banks. And that brings us on to one of the really interesting things that I want to talk about in terms of bonds that it took me a while to understand. Because if you think of bonds as being an asset that's less volatile than stocks, for example, then you kind of miss some of the interesting and strange things that can happen with bonds. To explain what I mean, think of it like this. When you buy a bond to invest, you're buying a bond because it will give you interest payments. So it will give you regular interest payments and the cash flow, but you're also buying it because it has a capital value. So as I mentioned before, a bond has a nominal value that you get when it matures, like it might be worth 100 upon maturity, but the market could value that bond much higher. It might be worth 120, 130, whatever. These are just fake numbers, but I'm just trying to explain that a bond also has a capital value, and that value can change. It can go up and down in value. So what makes a bond go up and down in value? And this is where it gets really interesting. And basically, the value of bonds respond to interest rate changes. Essentially, the important thing to think about is this. If a central bank changes the interest rate, then bonds will change in value. Sometimes they won't change very much at all, but sometimes they can have huge changes in value. All of that traditional wisdom about the role of bonds as being kind of a stabilizer to a stocks portfolio is true when it comes to short-term bonds. Bonds that have only a year or two of duration before the principal is paid back behave more stably than stocks do, and there's good reason to use them to take some risk out of a stocks-only portfolio. I understand those arguments. I can see why people think about bonds in that way. However, here's the interesting thing. The longer the duration of the bond, that is, the longer the period before you get the principal paid back, the more volatile bonds become, and especially towards interest rate changes. In fact, bonds can be very volatile. If they're very long, let's say 40 or 50 years, they can respond very strongly to interest rate changes. It also depends on what the interest rate is at and how big the change is. So that's what I'm going to try and explain in this episode. And it's a little bit complicated. I came to understand this because the approach to investing that I learned, Harry Brown's permanent portfolio approach, actually takes advantage of this approach and uses bonds as a hedge against interest rate changes. So Harry Brown really understood this property of long-term bonds, and rather than seeing it as a kind of a risk, he sought to use it as a way to hedge against certain things happening in the economy, like, for example, interest rate changes, especially interest rates dropping, which can happen during times when a central bank pushes interest rates very, very low, like they have been since the 2008 recession. So that's sort of how I came to understand this. And now I'm going to try and explain a little bit about how this works. The way that it works is through something called bond convexity, which sounds very technical. And if my explanation isn't good, you can look this up yourself and try and understand it a little bit better. But bonds have this property called bond convexity. And it's about the relationship between the bond price, how much you have to pay to buy a bond, and the bond yield, how much interest it pays. Now, here's my very, very simplified explanation of this, and please do look into this yourself. The longer the bond, if it's a very, very long-term bond, then the more strongly it's going to respond in value to interest rate changes. So the price of a bond is going to respond very strongly to changes in interest rates. So if the interest rate falls, then the price of a bond will go up, the value will go up. It seems kind of counterintuitive at first, but the reason for that is you have to buy more bonds in order to get the same amount of interest that you were previously getting. So if you bought a bond while interest rates were very high, then that bond pays high interest. And then if interest rates fall, you're holding a bond that pays higher interest rates than the interest rate of the market as a whole. And that means that your bond is actually worth more. So the price will go up until it matches the interest rate in the market. So what you need to understand is, for long-term bonds, if the interest rate falls, the bond will go up. Now, if you're talking about a 0.5 percentage point change in interest rates, when interest rates are very high, like say interest rates were 10% and there was a 0.5 percentage point change in interest rates to 9.5%, well, that would only be a 5% reduction in the amount of interest that you're getting. And so the value of the bonds will go up, but not by that much. However, if interest rates are really low, like they are now, just for argument's sake, let's say you're in a market where interest rates are 1% and there's a 0.5 percentage point reduction in interest rates, well, that's actually a 50% reduction in the amount of interest that's being paid by the bond. So that is a much more significant push on the value of bonds. So if interest rates are already low and they fall further, the value of bonds is going to go even higher. So this is something interesting that happens with bond convexity. And I'm telling you about this because we are in one of those times when interest rates are incredibly low. And so even what looks like potentially small changes in interest rates, like 0.25 percentage points, that can have a big effect on the value of bonds. So as interest rates have been approaching zero, as the rates have fallen downwards in the West, each half a percentage point lowering of interest rates has had more of an impact on raising the value of bonds. So essentially, bonds have been a hedge against falling interest rates in this period since 2008, when interest rates have been held artificially low. But here's the really interesting thing. At some point, those interest rates are going to go up again. And this is a very unusual period that we're living in with these incredibly low interest rates. So the interesting thing here is that if you hold bonds, you're hedging against lowering of interest rates. But if interest rates rise from a very low base that they are now, then the value of bonds could be significantly lowered. And this is why people talk about it having been a bond bubble in recent years in the West. Bonds have been in this artificially high valuation. And the risk is, if interest rates do rise, that could have a very strong impact on long-term bonds. So not only is this a potentially useful thing to hedge against lowering of interest rates, but it also can really bite you if interest rates do rise. I know that is a very technical explanation, and it's hard for me to explain this in very simple terms. And of course, as I mentioned, this is just my understanding of things. But just to summarize, here's the things that I've told you about. Bonds provide interest payments. And if you buy short-term bonds, often they're used as a kind of a more stable investment in a diversified portfolio, particularly for those people who hold stocks and they want something that's a bit less volatile. They buy short-term bonds. However, long-term bonds, although they still pay interest payments like short-term bonds, they have some slightly different properties. And in particular, they're much more sensitive to interest rate changes. And when the interest rate falls, long-term bonds can shoot up in value. But when the interest rate rises, long-term bonds can really decline in value. So they're kind of a hedge against changes in interest rates, and they can be quite volatile, really long-term bonds, to what look like small changes in interest rates, especially when the interest rate itself is very, very low, because that's where each sort of half percentage point or quarter percentage point change makes much more of an impact. And that's something that I came to understand about bonds that I wanted to convey to you, because if you are investing and you're thinking about the different properties of different investment asset classes, then understanding something about bond convexity can help you if you want to try and understand what you're holding bonds for and what might happen in terms of the value of bond if interest rates change. Short-term bonds are still responsive to changes in interest rates, but less so than long-term bonds, so they're less volatile. And the reason I'm talking about all of this kind of stuff is because if you want to take control of your own financial life, you have to teach yourself investing. That's what I had to do for myself. I'm just trying to convey these concepts in a way that hopefully is as easy to understand as possible, so that you know some of the things that you need to look into yourself and understand yourself. And that's one of the aspects of bonds that I think is a bit less well known or less talked about, which is actually still quite important in terms of potential risks and potential benefits that you might face if you are an investor. If, like Harry Brown, you use this characteristic of bonds to hedge against lowering interest rates, you can benefit when rates go down and get an increase in value. And that's what's happened to bonds since 2008. But on the flip side, that part of your portfolio could also get really hurt by increases in interest rates, because the value of long-term bonds will respond to those interest rate increases. So I hope you find that helpful, and I'd love to hear your thoughts. That's all for this week's episode. Good luck with your investing and your own journey towards financial independence.
Thank you for listening to The Voluntary Life. If you like this podcast, please show your support by becoming a patron of The Voluntary Life on Patreon. Your support will help to grow and improve the show, and you'll get access to a treasure trove of rewards, including bonus episodes. Visit thevoluntarylife.com to learn more.